Okay, welcome to our July 2026 podcast. My name is Brett Hina from Cornerstone Private Wealth, and as always, I'm with my partner here, Dan Lesneski.
Hey, Brett, it's good to be here.
Happy to be in the studio, and happy 4th of July weekend.
Same to you, 250 years. Can you believe it?
Absolutely. Happy 250-year birthday to our country, and we're enjoying it today. We're sitting here just to put a timestamp on when we're talking. It's July 2nd at about noon. And it's about 105 degrees outside. So Dan's been in the studio for about an hour sweating it out before I arrived. So.
Yeah, exactly. Yeah, it's not exactly cool outside, but that's okay.
We can make it through. So we are, I mentioned it's July 2nd. So surprisingly, we're about halfway through the year. So what we thought we'd do this year, it's been a volatile year, but it's been a good year so far, I should say. So what our plan is today is to put some observations out about what happened in the first half of the year and then look ahead for the remainder of the year. But you're going to hear some pretty good numbers today, Dan. So far, we've made it through halfway through the year, about 24 all-time highs for the S&P 500. That's pretty good. But if you kind of look at the recent chart of the S&P 500, you'll see last 7 weeks, we've been pretty much sideways. Yeah. In fact, we were just looking at it this morning, and the S&P chart is about where it was last on May 14th. So for the last 7 weeks, it's been pretty much broadening, out and just back and forth. Good news is tech was leading the way, and now we're seeing some other sectors, pick up the slack. So I think that's a good thing.
I think that's a good thing too. And thinking back to this time last year, we were talking about how mid cap and small cap stocks really had lagged, their large cap brethren, and certainly not the case this year. I mean, the small cap stocks and mid cap stocks have grossly outperformed large cap. And to your point about, tech, even leadership within tech has changed. And, we saw, big pullbacks in the hyperscalers in the last month and then a really strong performance from the actual hardware producers. So it's been an interesting time.
And we'll go over it. Let's go over some of the numbers. So for the first half, the Dow gained about 9%. And it's its best first half of the year since 2021. And the S&P climbed about 9.5% for the first half. But the NASDAQ did outperform the other two, up about 12% for the year. And notably, like you said, Russell 2000 kind of came out of nowhere, up about 22%. Best first half for small caps since 1991. So I think that's about 36 years. I think that was a bit surprising.
It absolutely was, especially if you compare the performance of small caps against the headlines that have been out there, right? We're still in that universe where the only thing people are talking about are either, artificial intelligence or the Fed.
Right.
And small caps have just kind of under the radar had a phenomenal year so far.
Yeah, and it's been, as I mentioned, 24 all-time highs for the S&P, but we've had some pretty wild swings, both in the market and also in energy prices due to the Iran war, and I guess the continuing uncertainty about where we're going to go with AI spending, right? But I think for me, the lesson from the first half of the year is that earnings probably still matter more than anything else, with maybe interest rates probably in second place there, right?
Yeah, I think you're right. And earnings picture remains strong. I mean, companies are routinely exceeding analyst estimates. And then one of the interesting things as well is we started to see some of the first kind of hints of, AI-bred efficiency showing up in some of these company financials. Right.
So we mentioned good numbers for the first half of the year, but most of that was due to a bounce back in the second quarter. Because if you remember back on our April podcast, the first quarter was mostly down, not dramatically so, but mostly negative numbers. The S&P, if you slice and dice it by the second quarter of the year, things are even more impressive. The S&P is up about 14.9% for the second quarter. NASDAQ up about 21.4% for the second quarter. And the Dow gained about 12.9% for the second quarter. So that was its strongest Dow gain since the fourth quarter of 2022. So that was good. And probably barring any kind of increase in hostilities between the U.S. and Iran, it seems like it's back and forth every year. Most pundits are still expecting a bull market for the second half of the year, mostly due to the earnings that we mentioned. And we're seeing investors move to some of the cheaper areas of the market. We've caught a bid here in financial stocks, which I think is pretty good. For example, even the NASDAQ, if I look at it on a monthly return, slightly negative for the last 2 months. Nothing dramatic, but slightly negative.
Yeah. No, and it's good that financials are starting to kind of come back to the party because, so far for the year, it's been a rough year for financials and certainly the consumer as well.
Right.
Right.
So we'll see, from a seasonality aspect, we're entering the dog days of summer, but July has been great, Dan. I was looking at some numbers through July. We haven't had a losing July for the S&P 500 since 2014. So I think that's, like 11 years in a row where the S&P has been higher in July with an average return of about 2.5% for the month. That's pretty strong. And the Dow, it's been historically the best month of the year for the Dow. And NASDAQ too. We've posted, for the NASDAQ 100, we posted 17 positive Julys in the last 18 with an average advance of about 4.1%. So seasonably strong.
No, and I was looking at some of the stats for the month as well, and just, you think about the S&P 500 in July over the past 35 years, it's like almost a 58% win rate in terms of positive months. Right. NASDAQ, almost a 67% win rate. So it's a great month. Unfortunately, August historically and September are not phenomenal months.
Right. We'll talk about that next month, right? Yeah.
So we'll enjoy it, make hay while the sun shines, so to speak. But it's been a really good start to the year. And I think one of the important themes that you touched on is just the broadening out in the market. There's still AI still remains intact, but it's changed a little bit in terms of hyperscalers not leading. Now we're looking at DRAM and CPU computing and things like that. But that remains intact, which I think is important for the ongoing sustainability of the market. But to see other sectors of the market participating, industrials, et cetera, I mean, it's good to see.
Speaking of other areas of the market, let's talk about internationals. International stocks have outperformed, especially emerging markets. I'm looking at some numbers in emerging market categories. South Korea up year to date 100%. So that's crazy. Nikkei, Japan market up about 39%. I would say be careful in South Korea because I notice it's down 8% today alone. So it can be pretty volatile.
And that was a story. What was it? 2 Mondays ago, right?
Right.
Overnight with the SK Hynix had a less than phenomenal earnings report, and that spilled over into the global markets. But again, we tend as investors in the United States tend to overly focus, I think, at times on what's going on here. And that's really been a tale over the last couple of years. Last year it was, broader Europe outperformed the S&P. Right. And now you look at some of the EM or more developing type economies, they're absolutely ripping.
Yeah, and we'll talk more about the South Korean market because it's some fun stats on that a little bit later. But, you're right. Europe, pretty muted. If you look at the SOX 600, that's up about 8% year to date. London FTSE 100 adding about 5.7% in the first half. Germany pretty flat, up about 1.9%, and France up just a little bit over 3%. Interestingly, some of the Southern European indexes did pretty well, but they're smaller markets. Spain up 12.5%. Portugal, I was just there last week on vacation, so maybe I contributed towards. I went to Portugal and Italy. I think I contributed to both economies. Portugal is up about 10.5%. Again, pretty small market. Italy up about 14.7%. So it's good. It's good to see that we had participation in a lot of categories. But inflation is still a thing, Dan. I was reading something this morning. You're seeing this over the weekend. That the American Farm Bureau said yesterday that the average 4th of July cookout is going to cost about 4% more than it did last year. So inflation continues to be a problem.
No, and I think, especially heading into the summer, I being out and about in the city, June was, I think, a pretty tough month, even with, tailwinds like the World Cup coming to the town.
Right.
And you're just talking to a lot of restaurant owners, and it's been very slow. Cost of goods are up. People are very concerned about their spending. So it's real. I mean, it's probably the most expensive July 4th in my lifetime.
Right, right. Yeah, but I'm going to share some comments. And by the way, Dan and I don't even talk about what we're going to cover, so it's going to be a surprise to him. But I was reading Mike Santoli, CNBC guy, does a great job, and he gave me some stats I was really surprised about. Last week, for example, the S&P was down 5 straight days, while more components were up than down each day. And that hasn't happened over a 5-day period or a 1-week period since 2000. So we're seeing
That's wild.
small number of stocks do well at some points where, and the correlation between even stocks in the S&P is pretty low. For example, rolling 1-year correlation between the S&P and the equal weight version has fallen to about 0.79. So
Wow.
even markets compared to themselves are not necessarily correlated. And that was another 25-year low. So to explain that to clients, so typically there's 2 ways of slicing and dicing the S&P 500. The most common way is the market cap weighted. So NVIDIA, Apple, Microsoft, they're going to be the largest weighting. Alternatively, you can look at it and take the same 500 companies and just equal weight them, same percentage. For the last 25 years, the correlation between the two is about 0.96, right? Because they are the same stocks, just weighted a little bit differently. Now it's 0.79. That's the lowest ever for the index. Kind of weird, right?
That is very weird, but that tracks with what we've been seeing. I mean, it's really been such a small subsector of companies that have driven performance, and that cuts both ways, right? The lack of a correlation there, or I'd say the diminished correlation between the two, has been helpful on down days, and as the market broadened out in June, right? You had some participation from the other 493 or so stocks in the index. But yeah, certainly when they're running, it is been really the tale of tech. But even with that, right, looking at that small subsector, if you look at hardware producers or hyperscalers versus, say, software companies within tech, that story this year has been dramatically different.
Right.
I mean, I was looking at just some of the top gainers and losers in the S&P over the first half. You've got SanDisk up, north of 700% on the year.
700%.
You've got Intuit down 60% on the year.
Right.
So it's just Micron with a very modest 300+% gain, and then Salesforce down north of 40%. Right. It's just it's a very very fickle market right now.
Yeah, and I wonder the money that's going into those stocks is coming out of some of the others. There's also Julian Emanuel from Evercore ISI had mentioned that there's, and again, this is kind of a record, 80 names in the S&P 500 have a complete negative correlation with the market itself, which has never
That's
happened.
incredible. Yeah.
So that's, but he thought he looked at that as a positive because you can go into get some diversification by utilizing some of the 80 names. And I can't remember a time where you've had, and today was an example where you have Dow higher, NASDAQ lower, or vice versa. Typically the markets move closer, in sync, but it's we have a lot of divergent days.
What is the stat I saw as well? Semis are 20% now of the S&P 500.
Yeah,
I mean,
tech's 40, but just semis.
Just semis are
themselves,
just 20, and that was closer to like a 2% weighting a decade ago.
Yeah, and a high, if you look at high volatility, for example, in June, just the month of June, the Philadelphia Semiconductor Index averaged a 4.1% daily move. So
Not
either
bad.
up or down by 4%. It's not a great way to live, right?
No, not for the faint of heart.
So I have a sheet here in front of me. Luckily for everybody, I didn't bring we don't have a lot of slides. We'll cover the slides in our client webinar, but I do have 10 or 11. I think there's 11 different observations. I haven't shared this paper yet with Dan, but we'll get your opinion on a couple of things. That a lot of this comes from Tony Pasquarello from Goldman Sachs. He puts out a lot of observations and facts and figures, but some fun stuff in here. Point number one, I want your opinion on it, is if we finish the year about where we are now, which is about 75. If we finished the year above 75.30, last I checked with the S&P 500, we were at 75.33. So right here, if we're over 75.30, it marks the fourth consecutive year in a row that the S&P will be up. Okay, more than double digits. Okay, and that hasn't happened in the 68-year history of the S&P 500. Only one other time. Happened one other time, and that was 5 years in a row from 1995 to 1999. So kind of interesting.
Well, yeah, it's I would say that's very interesting and also very scary in some ways, right?
Because of that endpoint, right?
Yeah, we know what happened in 1999 and the early 2000s, and while different in many ways, it was a tech fueled rally in the late 90s, and so good thing to, that definitely gives me a little bit of pause.
Yeah, and you mentioned point number 2, and you mentioned this briefly already, but while some high-profile stocks are way off their highs, I give you a couple of examples like Microsoft. Yeah. It's down about 30%. I was at 555 for a year high. I was at 384 this morning. Meta, which is Facebook, down 25% from its high. So a lot of stocks are way off their highs. But the markets are, within 2% of our highs, and it's because of what you said. It's these memory stocks, AI stocks, or data center stocks that are pulling it up, the numbers up, right?
I mean, and if you look at a Microsoft chart, that chart is ugly, right? And you would think at 30% down that it would be, approaching kind of oversold territory, but it looks like it still might have some downside to it. It's been a really interesting time in the market. And, speaking of, kind of companies that are off their highs, we just saw, this week where Meta kind of had a little bit of a pivot, right? Mm-hmm. They went from, just pure CapEx spending and building out capacity to now, basically looking for ways to sell some of their compute out there to other AI-enabled companies, right?
They had a 10% move on that news yesterday, but it was down a fair amount today, and maybe down 3%.
Yeah, so even within the AI story, it is constantly evolving, and it's just going into the midterms, it's going to be a little bit of a bumpy ride, I think.
Yeah, and here's another wow for the year. If we can go back to our January podcast, we were talking about the market went into the year expecting about 2 rate cuts. The consensus was 50 basis points of cuts in January. Now the consensus of this morning is about 37 basis points of rate hikes.
Yeah.
So if you see a change like that in the market, you would think the market would be a lot lower.
Yeah. Or you'd think, inflation has been persistent and persistently high, but, you would look at that and say, oh man, it must be even substantively higher than where we're at right now. It's, just looking out too. Again, this time last month when I looked at the September meeting, probabilities were still skewed in, no change. It's up to 55% for a hike now in September.
55% hike.
And then if you look at
what's the probability for a rate cut in September?
Rate cut in September is 0, no change, 44.6. And then if we go to December, it's a 78, almost 79% chance or likelihood of a hike.
Wow. Okay. So that's you would think a reversal like that would have caused the market sell off, right?
Yeah. Well. And then, but it's interesting, and you talked about this before, I think a couple episodes back, but just the price action, heading into a midterm. Right. August, September tend to be pretty volatile months. You start to settle in when you're about 22 days out, right? So, beginning of October, mid-October, heading up into the election, and then the period after, midterm election tends to be very positive for the market. So, I don't know if we've used up all of our good luck so far in the first half, or, do you think that trajectory holds?
Right. Who knows? Yeah. But the broadening out seems interesting. But we're, again, we do this podcast not to become Joe Rogan. We do this podcast to answer some of the most frequently asked questions that we get from clients. And one is, okay, wow, it sounds great. I hear it every time we mention something that's up a lot. Why not go into these emerging markets more? One reason would be, like, I'm looking at South Korea again. Tony Pasquarello, from Goldman Sachs, wrote in his notes that it's about 100% increase so far, but it's all that company. One company's 30.
Yeah, SK Hynix.
It's about 30% of the index. So goes SK Hynix, so goes the South Korea market. But so far this year, yesterday was a trading halt. They have the same circuit breakers that we have, pretty similar, I think, in the S&P 500. We will close the market for 15 minutes if we have a 7% sell-off, okay? By the way, yesterday was the 6th time that's happened this year in the South Korea index. So if you get in, they can get an 8% sell-off at any particular minute. So that shows it's pretty risky. By the way, since the S&P, we started doing that in 1988 after
Black Monday.
After Black Monday in 1987. We've only had 5 halts in the entire history of that. They've had 5. Yesterday was the 6th market halt.
Just this year.
For South Korea. So it's not for the faint of heart, right?
So what you're telling me is we're not necessarily going all in our retired clients' portfolios on the South Korean market.
We don't want to do that.
Okay.
Yeah, it's too risky after 100% move. And luckily, we're in many cases preaching to the choir for our clients. Our clients know that they've been hurt before in certain areas. So I think that was an increase. Interesting. What else stuck out for you in the first cap? You mentioned small caps, but small caps, and we don't think of small caps as an AI play, but they are an AI play.
Well, no, just look at the price appreciation of some of the, while not a small cap name per se, but the theme kind of persists. Think about the market cap of a company like Micron now, right, versus at the beginning of the year. It's a $1 trillion company now. Wow. It was considered a value play going into the start of the year. Right. Right. It's just crazy. But yeah, there are providers all across the cap structure and across industries. Especially in things like power generation and cooling and real estate, et cetera. You've got companies across the cap structure that are participating, that are really enabling, this transformational technology.
Great. So I didn't identify all the other. I didn't identify point number 4, 5, and 6, but we covered them. Point number 7 I thought was interesting through yesterday. The Magnificent 7 stocks that we've been talking about for the last couple of years, finally flat year to date. So over a 6-month period, we mentioned Microsoft and Meta were down from their high. So if you look at the rest of the S&P 500, we'll call it that 493, they're up 16%. So that's a pretty good story to show that we're broadening out a bit.
It's great. It's a great reversal from the last couple of years. That's for sure.
Right, where it's been, you've seen the charts, we've shown the charts before where it was all S&P 500. It was all Magnificent 7 moving the S&P 500, I should say. Also, gold and silver down a lot from their highs.
Well, that and again, I know we talked about this a little bit last month, but that has been really a spectacular kind of fall from grace in the short term, right? Especially during a period of geopolitical uncertainty where you thought, you could have some selling, but it would hold in there as kind of a traditional type market hedge. But the rise in the first quarter of the year was so dramatic that that was a first spot where people were taking money off the table. And and that's been true, by the way, for commodities kind of across the board. It's been really interesting. Oil's pulled back from its high, gold pulled back from its high, copper, silver, et cetera. It has been pretty interesting to see. I'm just looking, for June, you had crude down almost 18%, gold down 12%, Bitcoin, right? Talk about digital gold, right? North of 20% just in June alone. Silver down almost 22%, corn, wheat, copper, natural gas, all negative on the month. It's been wild.
Another interesting factoid that caught my eye this last week. We talked jobs report came out weaker than expected this morning. Okay, so that came out on Thursday because we're closed for the July 4th holiday on Friday. Typically, you have the jobs report on the first Friday of the month. And then we revised downward last month, so it's a little bit weaker than expected. But interesting quote that I saw about, how dynamic and constantly changing, I should say, the job market could be in this country. If you look at 1960, for example, there were around 1.5 million workers in the U.S. that worked in the healthcare industry. 1.5 million in 1960. Today, there's over 18 million. So that shows you how a sector can grow. I thought that was just kind of an interesting. Wonder what the breakdown would be in AI now and 10 years from now, right? In that sector.
Well, and being in Philadelphia, you think
Right.
about it. Who's the biggest employer in the city? University of Pennsylvania and that hospital system.
Right.
Think about a city like Pittsburgh. Same thing with the Pittsburgh medical center, and it's yeah. I mean, that makes sense, and I think that trend probably continues, right? As we have this demographic shift with baby boomers, and we have, more retiring, more, into their advanced years, requiring additional care. It is very interesting. But yeah, do you think on the AI side, with how that's changing the market, do you think that ends up being a net job creator? Or, I think much of the, at least headline right now, is the risk of net job losses.
Right.
But I feel like that's kind of a trend around every, technological advancement, is there's this fear of, hey, all these jobs are going to be destroyed, but new jobs get created. What's your thought on that?
My thought would be yet to be determined. I think we're right now we're at the capital expenditure phase where they're throwing a lot of money into AI, and we see it in our business, and we're entering the phase where we'll figure out what to do with it. You look at us as a small firm with 11, 12 employees. Have we seen AI that would actually replace employees? In our case, not so much, because we're in growth mode, but implementing that is, I think, still yet to be determined.
Yeah. Well, and also AI, as a tool set, needs to become more focused, right? Everything now has an AI attached to it.
Right.
Our quotes have AI attached to it. Our note takers, our, research portals, our email, everything, right? So it's, you have all these disparate tools as well, and you wonder, when you're using all these different tools, like, is it actually adding
Right.
efficiency for you, or are you spending more time trying to figure out the best prompt, to get the answer that you're looking for?
Yeah, like doom surfing on the internet. That's been
Doom prompting. Maybe
right.
we just coined a new term.
Exactly. So let's, the remaining part of the podcast, let's talk about looking ahead for the remaining part of the year. As I said, most pundits are still bullish. They're thinking that we're going to have a positive end of the year. One thing I saw recently is that if you look at margin balances, so the clients know, I don't think any of our clients are on margin. But if you're an aggressive investor, you can margin your portfolio and buy more stocks on margin. Mm-hmm. By the way, the margin balances are up, reported yesterday, up 55% over last year. So it shows that people are taking risk. I also saw there's a huge amount of money in these triple or double leveraged ETFs. None of our clients have that either, but you can go out and buy a triple leverage on a particular security like NVIDIA. There's a lot of gambling out there too, so it shows that there's a lot of, a lot of interest in the market, a lot of speculation in the market. Sometimes that, for example, the margin can be that can be a sign of the top.
Yeah. Well, thinking about between 2000, between the crash in 2000 and 2007, you saw a dramatic increase in margin balances relative to the organic growth of the markets, and that was, in hindsight, a wonderful precursor. So definitely something to keep an eye on.
Something we won't be using, but I think the answer will be for the second half of the year is if earnings continue to get revised upward, the market should hold up pretty well. If you look at it looking at the numbers through this year, so just back in January, if you look at S&P per share earnings increase, the consensus has been increased by $24 a share. Okay, so that's a huge number. We're now, the expectation is year end that we're going to finish about $344 per share for the S&P. And by the way, 2027 looks even better. And now that's been increased by about $48 a share, and we're looking at about $400 earnings per share for the S&P 500 for next year.
So here's a question on that. So we've seen over the last handful of years, I mean, I guess 2022 is the closest thing we've seen really since the financial crisis in terms of a very painful full year market performance. We've had really steep intra-year declines.
Right. And all V-shaped recoveries.
And all V-shaped recoveries. Do you think structurally the market with, you know, the pace that information's coming out and how many participants are there and kind of the gamification of really everything, whether it's predictive markets or just the stock market in general, do you think that having a prolonged downturn, you know, full year, multi-year, has the structural, you know, has the market changed enough where the price discovery is so good that that just doesn't happen?
You wonder, because the technology's there, and I think the more the habits of clients are more the buy the dip. If you just look at it for, this is anecdotal, but if you look at the last couple corrections that we've experienced for clients, not a great deal of concern. If you look at this year, you know, we had the Iran breakout. We didn't have any clients call and say they want to sell out per se. Last year with the tariff tantrum, for the most part, our clients, I had so many clients say, hey, I didn't look at my statements, didn't go online, because they expected a V-shaped recovery. So you wonder that mindset. People have been in it a while, and more people are in the markets, whether it's just through their 401k, that experience level, you find more buyers coming in. It would have to be some major breakdown that we haven't seen.
Hey, and by the way, we didn't talk about the biggest item that happened in June. Right? We didn't talk about the SpaceX IPO.
Let's talk about it. Huge, right?
I mean, what talk about a volatile investing period, right? I mean, it opened up huge on its offer, and then it has been a pretty challenging and quickly developing story. Not only did they IPO, but they also did an enormous bond offering.
Right. Exactly.
It's trading right now at $157 a share, roughly. I mean, that is barely above its offer price when it hit the market. I mean, I think it opened around 155 on initial trade.
Right. The price was at 135, and then it opened at about 155. Yeah, right about where it is now, and then got hyped up to what was the high intraday that particular day. I mean,
at some point it was trading in like the 180s. I mean, it's really. I'm trying to see here, pull a 52-week high and low on it. Not that there's a. Yeah, so 52-week range, 147.11 on the open to 225.64.
I know. Remember, it was over too. Right. So it became instantly one of the largest companies in the.
Now, do you think the relative volatility of that IPO in the short term gives pause to, OpenAI, Anthropic, some of the other big?
I think it shows just same thing. The margin and the 3-time leverage show is that there's a whether it's individual investors or institution, a big amount of speculation out there, and people are just comfortable with risk. That could change pretty quickly, but things are surprising. Another item we didn't talk about is look at oil prices. I mean, if you would have thought that the Strait, I guess it was closed for about 4 months, right? If you look back, because that happened in March 28th. We've pretty much round tripped. I don't know exactly where WTI spot price is today, but I know yesterday it was like below 70. It was about 65 from when we started. We started the conflict, so maybe it's up 6%. That's not that big. Interestingly, we should mention that
Yeah, it's right at West Texas is at 68. Brent's at 71 right now.
Yeah, so Brent's at 70, and so 68 compared to 65, not that big. Not that big. Interestingly, if you look at by AAA gas, average gas prices is up a lot higher. It was at 287 when this whole thing started, and I think as of yesterday it was about 385. So that's about a 34% increase, and that's a little frustrating. It's a little bit of like the rockets and feathers theory that we talked about a couple podcasts ago. And the theory there, it's an economic theory. And it is true that prices tend to go up like a rocket and they fall like a feather. It takes them forever to lower prices. Kind of reminds me of also the stock market. They say the stock market goes up an escalator, so it's up gradually.
And down an elevator.
And down an elevator. So it's things fall quicker. So who would have thought that it would have round tripped the way? But that's another positive, because we're talking about what should happen in the second half. That's another positive with inflation, right?
Absolutely.
Any other final thoughts heading into the second half of the year? Words of wisdom for clients that you'd be looking at?
Words of wisdom. No, just I would say, as we get later into the summer, volatility is going to, historically it spikes. I don't expect there's going to be a reason for that not to be the case this year. So, stick to your plans, call with headlines that are concerning, but really, expect a little bit of a bumpy road ahead between now and the midterms. Hopefully I'm wrong on that, but I think that's a pretty safe bet. And then the other thing is, rather than watching the financial news every day, just spend more time watching the World Cup, because it has been one for the ages. I mean, really one of the most entertaining World Cups I can remember in my lifetime.
The problem is I can't stay up that late. So you're younger. You were up.
I watched Team USA last night. Yeah, the late nights are catching up with me.
It started at 8 or 9.
8 o'clock.
8 o'clock. Yeah, the problem is I just came back 2 days ago from Portugal, so I'm still like 5 hours ahead. So I went to bed at the start of it. But yeah, it's been exciting.
And give me now, since we'll have some time, give me your prediction for the U.S. versus Belgium game. Do you think we move on?
I don't know anything about soccer, but I say they're going to win. So that means
I love it. Those are the informed takes we like here.
Exactly. But so as we approach the July 4th, we should end with I have 2 Warren Buffett quotes. I went through a bunch of Warren Buffett quotes because there's so many, and I think it's appropriate because he's a patriotic guy, and he retired finally at age 90, whatever he is. So one was I'll read the one from 2008, which is a great one. And this is from Warren Buffett. In the 20th century alone, we have dealt with 2 great wars, one of which we initially appeared to be losing, and a dozen or so panics and recessions. We had, high inflation that led to a 21.5% prime rate in 1980, a Great Depression in 1930, when the unemployment ranged from 15% to 25% for many years. That was pretty tough. America has had no shortage of challenges. Without fail, however, we have overcome all of them. And in the face of those obstacles and many others, the real standard of living in America has improved nearly 7-fold during the 1900s. So that's impressive. While the Dow Jones Industrial Average during the 1900s moved from $66, that's for the entire deal, to 11,497. I think that's a great quote to have clients think about things on the long term, and Warren Buffett always did a great job with that.
There's a reason he's the Oracle of Omaha. I mean, it always no shortage of great pearls from Warren. And one other, parting note I would leave. We talked about compounding interest on the last call or on the last podcast, and I thought it was prescient on the 250th anniversary of our country. One of our founding fathers, Benjamin Franklin, once gave a very famous 200-year gift to the nation.
Yes.
Right. So 1,000 pounds sterling to Philadelphia and Boston.
Interesting.
After 200 years, Philadelphia's through, mismanagement only grew from, 1,000 pounds sterling to almost 2.25 million.
Interesting.
Where Boston's grew to nearly $5 million when those funds were fully dispersed in 1990.
Wow. And we sent out an email to clients on that, so I've had some comments on that.
Oh, that's great.
Which is great. And the other one from Warren Buffett, let's say one final one, and this one I think was during COVID in 2022, and Warren Buffett said, Charlie and I have always acknowledged that Berkshire Hathaway could not have achieved its results located in any other country than America. Our country would have done splendidly in the years since 1965. The country would have done splendidly without Berkshire since 1965. But absent our American home, however, Berkshire would never have come close to being as successful as it has been today. So I thought that was a good patriotic theme. And the country, of all of our problems, there's a lot of stuff that does work. Right?
A lot of things that work, and a lot of things to be proud of, and a lot of things to be optimistic about in the future. And I think with that, we should finish up the podcast and go get some Dairy Queen in honor of Warren Buffett. So.
Absolutely. So for all the clients out there, we thank you again for your continued trust and confidence. And please spend some time celebrating this great birthday, 250 years, and have a great 4th of July. And we will talk to you next month.
Stay cool, everyone.
Thank you.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.